What's up, everybody? It is Monday, December 27th. I hope you had a nice Christmas, everybody. Today is Monday, so I sent out the new issue of MMT Trader. As I said, I am now making available individual user subscriptions. It's going to be reduced from, that is not the 1,250, which is the starter level for institutions. So if you're interested, send me an email at mnorman@pitbulleconomics.com. All right. New highs in the market today. Not a lot to talk about. Really, we're at the end of the year, so we're kind of winding down. 4 days more until New Year's Eve. And we're really going to get a better picture in January and February when we start to see the impact on those fiscal flows from the cuts in the child tax credit payments and also from the increase in Social Security payments. So I'll have a much better idea of what the fiscal situation looks like. And of course, that's the core of everything. That's what drives everything. That's what I talk about here nearly on every single video that I do. And it's how I guide you to where the market is going. And I've been saying we're in a very supportive environment for the economy and for the market. Now, I just saw some data today where retail sales increased by 8.5%. That is a 17-year high increase. So again, as I've been noticing here, at least in New York, is that people are out, they're spending money. And that seems to be the case nationally, in spite of the Omicron spread, which it's kind of frightening because this thing is spreading like crazy. I just got tested yesterday and I'm negative. So hopefully that stays the case. But cases are just spiking way up. I don't know where you are, but like in New York, we had like 56,000 new cases yesterday or something like that. It's ridiculous. But thankfully, this variant is not as lethal. It doesn't seem to be killing anybody. But still, it's disconcerting. It's a little bit worrisome. So we got to keep an eye on that. We got to keep an eye. I think I'm watching the Russia, Ukraine, U.S. NATO situation very closely. There was a report today that Russia pulled back about 10,000 of its troops on the border with eastern Ukraine, and they went back to their regular bases. But according to reports I read, they had over like 100,000 troops, so that was a small withdrawal if that's happening. Luckily, it was announced that Russia, U.S., NATO are going to hold talks in January, so hopefully the tensions will be brought down to a more manageable level. I just think that's something that if that erupts, if we get hostilities there, that's going to be bad for the market, and we don't know how that's going to play out. I mean, if that turns out into a full-blown, hot war, Russia, U.S., God forbid, I mean, then there's no telling how far that can escalate and how the level of potential danger is unfathomable. So let's hope that cooler heads prevail. And when I say that, let's hope that cooler heads prevail on Washington's side, on the US side, because it really looks like US and Europe and NATO are trying to push Ukraine into triggering something here, but hopefully nothing's going to happen. Again, on the fiscal stuff, man, like I've been saying, I don't see any prospect for a big deceleration in those flows. I think the flows are sufficient, even if we go slightly below 500 billion a month. That's a positive environment for the economy and for the stock market. It even goes as far as alleviating some of the price pressures. Look, fourth quarter GDP is supposed to come in close to 10%. I mean, that's incredible. So, if we ratchet it down to 2-3%, which is historically probably the trend line average, we had that during the Trump years, and you saw how well the market did. We are seeing a reduction in the deficit compared to last year. I mean, the deficit is now down almost 100 billion, I think like 98.9 billion compared to last year. And I think I spoke about this, on the flip side of the automatic stabilizers being, of course, Social Security, Medicare, Medicaid, unemployment benefits, food stamps. Those are the things that kick in during recessions when people lose their jobs and they go to the government and they get support. And that naturally expands. That's a natural fiscal expansion that creates like a safety net under the economy. On the flip side of that, you actually have the reverse happen. When the economy grows, the government collects more and more taxes off of that growth. That's from corporate profits. It's from earnings of individuals and businesses. And those tax receipts grow, and they tend to grow faster at a certain point than the spending. And so that shrinks the deficit. And the deficit, of course, is the net financial transfers from the government to the non-government. And we see that now in personal savings. Personal savings down to 1.25 trillion, which is still historically very high. And by the way, that's the November figure. But, last year, April, May, when we really got the massive fiscal stimulus for the pandemic, personal savings shot up to 6 trillion. So now they're down to 1.25 trillion because of those tax flows that, taxes take away. This is classic. I mean, everybody who thinks the deficit's a bad thing, the deficit adds to the financial balances of the non-government. That's how come when the government ran this very sudden large deficit, it immediately added to personal savings. And now that the deficit is shrinking, those personal savings are coming down, because that is, when I use the swimming pool analogy again, that is draining out the swimming pool. Okay, the level is coming down. The water's still flowing in at a high rate, but now you got a leak in the pool and it's slowly starting to come down. The water level is still high. I'm not going to say it's not, but it's slowly, now we're starting to see it come down. It's not problematic right now, but at a certain point it could be. And when that point comes, I'll let you know, or I'll let my subscribers know anyway, for sure. So I'm not worried about that right now. I'm keeping my eye on it. As long as these flows stay up around 500 billion, I think that's going to be fine. And it'll take a while at this drain rate, if I can use that term or that phrase. It'll take a while for that deficit reduction to, create any kind of a worry. I mean, right now it's not. So basically, and I talked about this last week. I said sentiment was very negative. It was very bearish. Everybody was freaked out about, what the Fed was going to do right at the December 16th meeting. They're going to speed up the taper, 3 rate hikes in 2022. Oh my God, it's so horrible. It's so terrible. I said, there's your buying opportunity right there. And everybody still thinks that the taper is taking away the punch bowl. I've explained like all that is just diverting that income transfer from the government into the economy now, as opposed to where it was going from the government to the Fed. I mean, anyone who thinks, that's the same exact thing monetarily as sending out checks to people. Maybe it's sending out checks to a different class or a different status of people, but it's sending checks into the economy, and everybody's saying, that's what we need to slow inflation. Well, that was the same thing you were screaming about, saying that it caused inflation when they were actually sending out checks to people. It's the same thing. Monetarily, fiscally, it's the same thing. It just goes to a different cohort, a different class of people. It shows you how people have this so wrong in their understanding. So anyway, today's quiet. I mean, I've been walking around the streets here in New York. You know, I wake up at 4 a.m., I work out, I do my runs early in the morning. I mean, it was empty. It was empty. I think a lot of people are away. A lot of people are on vacation. Maybe people are just staying home because of the COVID situation. I could understand that. So we really got to get into next week and, you know, the first few weeks of January to see what's going on. But right now, it's all looking good. I mean, I don't see any change in the flight path, no change in course. It all looks good. And, you know, we'll just keep tracking it. Anyway, that's it for now. Don't forget to go to my website, pitbulleconomics.com. And if you're interested in signing up for the report as an individual subscriber, send me an email. Mike M. Norman at pitbulleconomics.com. See ya.